So welcome again to everybody to today's seminar on the topic credit ratings and the COVID-19 crisis. My name is Elena Carletti. I'm professor of Bocconi professor of finance, at Bocconi University, and I will be chairing the debate today. So first I will introduce the speaker in order of appearance. So we have Stefan Hynes, who is a policy officer in the Department of Rating, Indices and Securitization at ESMA. Then we have Gwénaël Pover, who is a senior supervision officer, also in the Department of Rating, Indices and Securitizations at ESMA as well. So they will give the initial presentation. And then we have Colin Ellis, who is a chief credit risk officer in EMEA and the managing director in the credit strategy team at Moody's. And lastly, Richard Portes, who is a professor of economics at the London Business School, but also he is the chair of the advisory scientific committee of the European Systemic Risk Board. And today he will be speaking also, if not in particular in that capacity, given that he's involved in some work that the ESRB is doing on the topic. So first of all, thank you to all of you for joining the debate today with us. So we know that there has been a lot of debate recently around or about credit ratings and credit rating agencies, in particular due to the fear of massive downgrades as a consequence of the crisis we are living and the impact that these downgrades may have for sovereigns, for banks, for other market players. Also because, as we know, sometimes, in particular when we go into the junk and non-investment grade territory of ratings, these downgrades may generate automatic responses and therefore may have a bigger impact than other downgrades may have. So against this background, what we are going to do today is to discuss the regulation and the supervision of the ratings, and that's why, and the credit rating agencies, that's why we have ESMA representative with us, the impact of recent or future downgrades on issuers and markets, and also recent policy responses, in particular that of the European Central Bank, that somehow weakens or at least try to mitigate the impact of potential downgrades. In terms of organization, as I said, we are starting with Gwénaël and Stefan that will give will set the framework of the regulation and supervision of credit rating agencies, and then we will go to Colin and finally to Richard. And I remind you that we said 12 minutes, 15 maximum for the ESMA, and then 8 to 10 minutes maximum for the others. As usual, our idea is try to engage in a discussion also with participants. So please, the participant, your question, post your question in the Q&A box that you see at the bottom bar of your screen. You can post questions along the whole seminar. You don't have to wait until the end of the initial presentations. And as usual, please try to ask brief questions, possibly indicating the name of the speaker you would like the question to be addressed, so that I try to be more efficient in my management. So having said that, with no further ado, I would like to give the floor to Stefan, please.
Thank you, Elena. Thank you all for taking the time to participate today. My name is Stephen Hynes, and I'm joined by my colleague Gwénaël Pover. And we look forward to discussing the CRA regulation and supervision in the EU. So we would say, why is this topic relevant now? There's generally more attention on credit ratings in times of crisis, not least because credit ratings continue to play a role in financial markets and the decision-making processes of financial market participants. So to help introduce today's discussion, we thought it'd be useful to give an overview of the current state of the market for credit ratings in the EU, to provide an overview of how the CRAs are regulated, describe how this approach has evolved following previous crises, particularly in the area of sovereign ratings and reducing reliance on ratings. And finally, we'll take you through some recent market developments that we have noted through reporting to ESMA's public ERP database. So let's take a look at the current market for CRAs in the EU. Currently, there are 27 CRAs registered with ESMA. These are located in 13 different countries. Between these CRAs, you could say that there are significant differences in scale and operations. The market itself is characterized by a high degree of concentration amongst a small number of large CRAs who provide a full class of rating categories. Outside of that, you have some medium-sized CRAs who offer broadly the same class of ratings, but don't have the same market share. And then beyond that, you might have smaller CRAs who are specialized in certain industries or certain markets. So there's a wide variation in the structure and activities of these entities. But nevertheless, they are all supervised centrally at ESMA. So what form does this supervision take? Well, as the supervisor of CRAs in the EU since 2011, ESMA's tasks encompass the full range of activities of a typical national supervisor. These range from initial registration to ongoing supervision, and also encompass assessments of third country legal and supervisory frameworks for the purposes of the regulation's third country regimes. To carry out these tasks, ESMA has powers to request information from relevant persons, to carry out on-site inspections, to levy fines, as well as use policy instruments to ensure consistent application of the regulation. All these powers are set out in detail in the CR regulation itself and are supplemented where needed with technical standards. So what's important to highlight here is that we've had almost 10 years of supervision under this regulatory framework, which has given us, some level of oversight into CRA's activities and processes. But what does the regulation require in practice? Well, the goal of the regulation is to ensure that credit ratings that are used in the EU are reliable and good quality and free from conflicts of interest. And the regulation is quite detailed and prescriptive in how it achieves this. But to give you a quick overview, it includes provisions to protect against conflicts of interest, such as rotation requirements for analysts. It includes provisions to ensure sound corporate governance, such as requirements on board composition. And it includes requirements on methodologies, that they're rigorous, subject to back testing. And there's a technical standard which provides more details here. It also includes provisions to ensure transparency around credit rating actions, which is something ESMA has supplemented recently with additional guidance. And it's important to note that the regulation prohibits ESMA or other public authorities from interfering in the CRA's methodologies and credit ratings. However, perhaps of particular interest for our discussion today are some of the updates that were made to the regulation in 2013, and specifically provisions which were introduced in the area of sovereign ratings and reducing reliance on ratings. So we'll move to those now. So let's take these in turn. If you remember when CRA3 was introduced, we were in kind of the middle of a sovereign crisis. And one of the goals of CRA3 was to increase transparency and reduce market disruption around sovereign rating actions. And to do this, the regulation introduced some new requirements. For example, the need for CRAs to publish a sovereign rating calendar in December of a given year, setting out where it'll issue sovereign ratings for a given member state over the coming 12 months. In addition, there were new requirements that sovereign ratings only be published on a Friday after close of business of markets in the EU. To improve transparency, there were also increased disclosure requirements around sovereign ratings. So for example, a sovereign rating, there is a requirement to publish a detailed sovereign research report that includes a higher level of detail than a standard rating action. Another new requirement was prohibition against these sovereign rating actions, referring to any policy recommendations or domestic policy choices. And finally, these sovereign rating provisions were supplemented by new requirements that apply to all classes of ratings, such as the so-called 24-hour rule, where a CRA needs to provide the rated entity with at least a full working day before publication of the rating in order to identify any factual errors. So all very detailed, and you would agree providing some increased requirements in this area. And certainly publishing a sovereign rating on a Friday outside of market hours is a positive step, as it allows market participants the weekend to digest considered developments. So in addition to these sovereign rating provisions, there are also provisions in the area of reducing reliance on ratings. And you could say this was an issue which had more its roots in the previous crisis, where mechanistic reliance on ratings was identified as an issue. So to address these concerns, CRA3 introduced a number of new requirements in this area. First, that all market participants conduct their own risk assessments that do not rely on credit ratings. Second, that national supervisors should monitor and mitigate contractual reliance on credit ratings where this occurs. And third, that the Commission should investigate removing references to credit ratings in EU regulation by 2020, provided suitable alternatives were found. So these are quite wide-ranging. And how did it work out? Well, there was some success. Generally, regulation that followed CRA3 has avoided mechanistic reliance on ratings. And you can see this in UCITS, AFM, and IORPS. They were all amended following CRA3 to make sure these directives promoted an independent risk assessment. More recently, you can see that MMFs under the MMF regulation use an internal credit quality assessment to judge eligibility of assets. And ratings can be a factor in this, although not the only factor. And there are other examples, such as CCPs under EMIR, who use defined and objective methodologies to assess quality of collateral. So some progress. But you would say that regulatory reliance or regulatory references still exist in some pieces of text, notably CRR and Solvency II. And contractual reliance is still potentially prevalent. So where does that leave us? Well, you could say that a lot of work has been done in this area, but it's still a point of attention in the current environment. So that very quickly brings us through the regulation and supervision and some of the new developments. And what I'll do now is I'll pass over to my colleague Gwen, who will give maybe some detail on recent market developments that we've seen from ESMA.
Thank you, Stephen. Just trying to go to the next slide here. Also, welcome to everyone from my side. So as Stephen indicated, to walk you all through some of the recent market developments that we have seen. The graphs here on the left-hand side show the evolution of downgrades and defaults since basically it's week 11, so the first week of confinement in a lot of EU countries. As you can see, there was quite a steep increase in the number of downgrades, especially weeks 13 and 14, all the way up to week 20, let's say, and then slowing down after that. As you can see, the black line is the 5-year average. So the peaks in week 13 and 14 were quite significant. Defaults, on the other hand, are still relatively limited, as you can see from the bottom slide. In general, what we saw is that in the beginning, rating actions were largely focused on non-financial corporates and also concentrated, let's say, in the non-investment grade space. Ratings that tend to normally be more vulnerable to shocks as have occurred. As you can see from week 16 onwards, there's also some diversification in rating actions with more focus also on structured finance ratings that were downgraded. This slide shows the outlooks and the negative watches reviews that were issued by CRAs. This is more a predictive measure which shows the areas where CRAs expect further negative rating actions to happen. As you can see, also here significant amounts compared to the 5-year average. Initially focused largely on financial institutions and non-financial corporates, especially on the outlook side. And afterwards also a lot of negative watches and reviews on structured finance instruments. Although the numbers have reduced in recent weeks, what needs to be taken into account is that some of these watches and outlooks still need to be resolved. So this may lead to further negative actions down the line, depending also, of course, on how the situation develops, how government measures are being implemented across the board, and how the economy picks up again. Finally, what did these rating actions lead to, or the current crisis? Let's say what we saw is that, as Elena pointed out, the ECB has made changes to its collateral framework, meaning that it's now accepting instruments that have been downgraded to non-investment grade for its collateral framework. The ESRB published an issues note focused really on the potential pro-cyclical impact of downgrades of ratings. And I think Richard will speak to that in more detail in his presentation. And ESMA, let's say, as supervisor of CRAs, also engaged with CRAs from the beginning of the crisis to really understand whether business continuity was a risk, and also focusing on adherence to key requirements of the CRA regulation, for example, in the context of transparency. And also monitoring rating actions to assess the potential impact on financial stability This information is then, of course, shared with the national competent authorities around the EU and other stakeholders where necessary. And finally, we also always discuss with our fellow CRA regulators around the world on developments like this. I think I'll leave it at that and pass it on to, I think it's Colin is the next speaker.
Yes, thank you very much. Thank you also for being perfectly on time. So now we go to Colin that however I don't see on the screen at the moment. Colin, are you with us? In the meantime, let me please ask the participants that have already seen that they have already started asking questions to please ask your question in the Q&A box and not in the chat box if possible, so that I have them all in the same space. Well, if Colin then is not available, maybe Richard, you can go first and then Colin will do it after you. Please.
Okay, in that case, I've got to share my screen, get my slides up for you. Let's see whether that'll do it. Is that it? We're okay now? Are you hearing me? Oh dear.
We hear and we see. Yes, please, go ahead.
Okay, you hear and you see. Tomio. Okay, very good. I just stress before I start the disclaimer at the bottom that I am not speaking in any way whatsoever on behalf of ESRB or any of its committees or whatever. So that having been said, let's go onwards. I hope I go onwards. Come on. Why is it not moving? Move, please. This is very odd. There we go. So, yes, I'm going to cover two main topics and start with the general and proceed to the specific. There are long-standing issues regarding the role of credit ratings and the agencies themselves. And second, I will turn to our macroprudential concerns about the potential pro-cyclical impact of a wave of downgrades. I'm going to minimize the pictures that I see up there. I'm going to try to anyway, so that I can see my entire slide. Yes. Okay, so let's go down. Very good. I'm asking here the question that is, in a sense, the relationship between our two other participants, ESMA and Moody's, who is guarding the guardians. ESMA is indeed the regulator in Europe, and yes, the agencies have to make their methodologies and their assumptions public, but there is clearly a major role for subjective factors. Rigorous, Stephen referred to the rigorous, systematic, and consistent methodologies of the agencies. I'd be interested to hear him comment on that. My understanding, and I've had some long talks with all the three major agencies over the past several weeks. There is certainly a major subjective factor there, and reliance on judgment. Now, there are, of course, the well-known agency issues that have been around in the literature for quite some time in the way in which the industry operates. And there is a lot of empirical evidence, I'm afraid to say, from fairly well-known, fairly credible economists and finance professors and so forth, that point out many flaws in the ratings process and the outputs. That in particular, you could do just as well as the ratings by using some straightforward fundamentals-based models that anybody could construct and use with only public information. So what is the value added here? And the second point, as is obvious, the ratings lag. And that's not entirely the agency's fault, although I have to say they have updated their macro forecasts in this current crisis rather slowly, shall we say, and I can document that if you like. But it's clear that CDS spreads would give you a market indication very quickly of what might be happening out there. And a very important point going forward is that on the data in the past, the agencies have very heavily underestimated the default correlations across assets. The agencies are gatekeepers, and indeed on the grounds that they're simply expressing their opinion, they have been able to maintain immunity from any legal challenges. But the thing is, if you look at it, they're hugely profitable. Insofar as we have data on the public company aspects, they're hugely profitable. Why are they more profitable than newspapers if they're just uttering opinion? Well, it's the regulatory license. Frank Partnoy started working on this and speaking about this many years ago, and it's summed up in a long paper that he published fairly recently. The official endorsement by the authorities of the agencies creates barriers to entry, and this leads to, and what we see obviously is oligopoly, with 93% of the market in Europe now covered by 3 agencies, and of which one is much smaller than the other 2. So the ratings, as Stephen said, the ratings still remain in various aspects of financial regulation, and they lend themselves to mechanistic, we might say, application. And I'll come to that in a moment. So this is quick, and I'll pass, in fact. The point here is simply to show that investment funds are fragile, shall we say, in the current context. More important is that we saw serious disruption in March in the high yield market, and it was much worse than in the global financial crisis in 2008. So that is, we hope, not a taste of things to come. It stabilized after central banks intervened, but the concern, our concern, is that this could deteriorate. The picture could deteriorate in markets because of a potential wave of downgrades. And you've seen the data about negative outlook, so I won't pause on that. But I should say that there is a large proportion of the BBB segment, if you like, the marginal investment grade, which is under negative outlook right as we speak. And the transition from investment grade to high yield, that is to say, the creation of fallen angels, so-called, can potentially provoke problems given the existing tensions in the high yield market if you're going to dump a large amount of issues of securities into that market. And I'll give you some numbers on that in a moment. The BBB right now is about half of the entire corporate bond universe. And by the way, I should stress this, I'm talking only about corporates. Sovereigns is a totally different ballgame, and of course, politically very sensitive, and I'm just not going to go there even in the Q&A. So talking about corporates, and the forecast, the macro forecasts all around from both the private market participants and economists and even the fund. Now, the IMF forecasts of only 6 weeks ago were, as I said at the time, and indeed before they issued them, optimistic. And the agencies will have to adjust to this in their ratings. And that will come with a lag, as it has in the past. There have been, we expect, that is to say, I expect, despite some of the data that were shown a moment ago, I would expect a further wave of downgrades to the sub-investment grade status. Now, the agencies talk about rating through the cycle. That is not really, I think, appropriate in current circumstances. This is not an ordinary business cycle we're in. It's a crash, and we're not expecting, I'm not expecting anyway, a V-shaped recovery. And I think those who were, the numbers are dwindling. What could happen? You could have, with a wave of downgrades, a wave of forced sales by those institutions that are constrained by the regulations, I talked about that a moment ago, or their investment mandates to hold only investment grade paper, or who wish to avoid seeing their capital requirements go up because of the risk weighting changes, or simply they just want to stay out of the high yield market. They don't want to go there. If their securities are going there, they don't want those securities. We reckon that this could amount to more than 150 billion euros worth of the these new fallen angels in Europe, which is about half the size of the current high yield market. Now, it's not reasonable to expect the market easily to absorb that quantity. So there will be big declines in prices in these circumstances, and that will then affect balance sheets. And it will also affect the ability of those firms to get finance. We have a new report, indeed, referred to before, and at the bottom of this slide, I think the slides will be made available afterwards. At the bottom of this slide, there is a link to it discussing the macroprudential concerns we might have about corporate debt, and the ramifications of this could be very considerable. Now, you can't expect the agencies to consider the aggregate or the system-wide consequences of their individual rating actions. You can't expect them to be concerned about pro-cyclicality per se. That's just not reasonable. They wouldn't be doing their job, or their supposed job anyway, if they were to do so. So what we have done, the ESRB, is to embark upon an analysis at the aggregate level, a top-down so-called analysis, to assess the overall impact of a scenario, and in fact we're running several scenarios, of large-scale downgrades across all parts of the financial sector. And we're concerned that private sector actions, even if the supervisors intervene in a coordinated way, private sector actions may be unable to maintain market liquidity and to mitigate the other consequences I talked about a moment ago of heavy sales of downgraded securities. The central banks have taken some actions, and there was some reference to that, on the collateral framework for the ECB and the Fed with their asset purchase program. But we reckon there is still a risk of market disruption, adverse spillovers, and systemic effects. The ratings are still hardwired into the investment universe with negative consequences. So I'll stop there, and I'll stop share and get out of there.
Yes.
Go.
Perfect. Thank you very much. Now, Colin, you are back. Welcome back. So I'm sorry if we had to move with Richard. So please, now the floor is yours. Now you have all the pressures put on credit rating agencies, and we want to know everything about it. Please.
Thank you very much, Elena. Apologies, everybody, for disappearing. Internet reliability in the UK is still not always 100%. And thank you very much to Richard for stepping in when I was unavailable. I'd like to, in my remarks, I'd really like to just kind of make three broad points, and then we'll open it up for Q&A, because I think that's probably where a lot of the value is going to be. The first is to describe what we've done, just kind of add our perspective on what you've already heard from Gwen and Richard. The second is to talk a little bit about pro-cyclicality, because it is something that we do look at and focus on, and we've recently updated our research in this area. And then third, just a final point, which I think will chime very much with Richard's closing remarks. So this is clearly an unexpected crisis. When we were setting out our forecasts and our outlooks at the start of the year, we did not expect coronavirus to have the impact that it is now having. And I think that's consistent with what you've seen across a range of other forecasters as well. And it's unlike what we've seen in the past, exactly as Richard said. It's likely to be a very deep, very sharp shock. And then even though you might get a bit of a bounce because the extent of the fall is so pronounced, it's probably going to be a relatively gradual recovery, or at least that's what we're factoring in at the moment. But at its heart, the crisis that we're seeing today, and in particular, the disruption to normal economic activity as a consequence of the very sensible measures that governments have put in place to save lives, it really poses some very simple and basic credit questions when you come down to it. You know, how much revenue am I going to lose because I'm shut down for 4 months or 6 months or however long I'm shut down for? What can I do to stop that decline in revenue feeding through to my profitability? And how am I going to fund the gap? Those kind of perspectives around revenues and the bottom line and funding and liquidity are all classic credit questions. And that's really what we've been engaged in since we started our widespread kind of COVID-related work in March. And what we did was we set out a framework very early on where we identified which sectors we thought were more at risk and which ones we would be looking at first. And then essentially, globally, we have tried to touch every single rating we have over the past few months, just to check that those ratings that we think are robust look robust, to look at those where we think they're more at risk and try and provide our signals into the market as quickly as we can. And as the extent of the downturn has become more severe than we initially expected, again, in common with many other people, we've had to look again at those issuers in the kind of moderate category. But overall, we've tried to take a very measured approach here. You know, from our perspective, there will be an awful lot of issuers that do not default in this downturn. And the question for us is really to try and look through the short-term damage, look through the slightly longer recovery, and assess what kind of creditworthiness those issuers will have on the other side. And that's why you haven't actually seen many multi-notch downgrades so far. I mean, most of our rating actions, as you've heard, have been very concentrated in the corporate sphere with knock-on implications for things like CLOs. But the vast bulk, you know, we've taken over 300 rating actions on European corporates in Europe, and some of those corporates have more than one rating because they issue more than one type of debt. The vast bulk of our rating actions to date have either been to assign a negative outlook or a review, or a one-notch downgrade, which is not that significant in the context of a 21-notch rating scale. Clearly, we're signaling some weakening in creditworthiness, but we're not necessarily signaling a dramatic shift. So we're trying to be quite measured here. We do still have a number of outlooks and reviews in place, and we will try and resolve those as quickly as we can. Historically, I think on average over the longer term, whenever we've had an outlook before, and I tend to think about outlooks as kind of the balance of risks around a rating. Historically, if we've had a negative outlook in the past, then about a third of the time that has resulted in a negative rating action, a downgrade. Or if we've had a positive outlook, which is, they're a bit less prevalent at the moment, but if we have a positive outlook again, it's about a third of the time that's resulted in an upgrade. So yes, they are signaling mechanisms, but they're not automatically feeding through into future rating changes. That's just our way of telling the market and telling investors that we're thinking about the risks here. Of the rating actions we've taken so far, they are very, very concentrated in the non-investment grade sphere. So the vast bulk of rating actions we have taken are for corporate issuers rated single B or lower. And by definition, those are the issuers that you would expect to be more affected by this kind of unexpected shock. You know, we have already been signaling that we see some significant credit weaknesses in that universe because that's where they're rated where they are. It's worth bearing in mind that our rating scale, Moody's, speaks not only to the incidence or the probability of default, but also to the losses that investors may suffer. And as soon as we start seeing that kind of expected loss concept becoming substantive, you know, the rating should be single B or even lower, according to our own symbols and definitions. So we have done a lot of work, we've taken a lot of rating actions, but we've tried to be quite measured. This isn't a large swathe of multi-notch downgrades. We have not seen that yet. And that's because we do expect most issuers to survive and come out on the other side without defaulting, even if they might turn out to be weaker from a credit standpoint than they were going into the crisis. So that's a very quick description of what we've done. Pro-cyclicality, yes, I mean, this is something that we worry about, and I think Richard touched on it. Whenever you have a recession, there are going to be some companies that default. You know, we see spikes in default rates whenever you see economic downturns, and that, you know, we have to respond to those kind of crystallization of risks that we had previously been signaling, hopefully, in our ratings and our outlooks. You know, we can't not respond to that. So there is some sign that in credit downturns, ratings can be can move a bit more negatively. The net downgrade rate, the kind of balance between upgrades and downgrades, does kind of pick up a bit. So we see more downgrades in credit downturns, as you would expect. But it's not that pronounced. Over the past 3 credit cycles in the US, the average downgrade over the whole cycle is only about half a notch on our rating scale. So again, even there are some issuers that, of course, will see more substantial rating actions, and that may well be a precursor to default. But you're not seeing kind of widespread downgrades right the way across the portfolio. We're talking about half a notch across the last 3 crises. And the other thing we find when we investigate the kind of pro-cyclical phenomenon, which again chimes with remarks Richard made, is that actually we don't seem to amplify market effects. Most of the time when a shock hits, you see the impact in market prices, whether that's bond prices or CDS, before you see any rating action from us. And our rating actions aren't just notches, and the assignment of a negative outlook is a rating action. And that's partly because we have to give issuers the time which they deserve and need to kind of review the rating action. But it's also simply because financial markets are the jump variable in our economies. They are the things that react very, very quickly. And if you look at the past 2 downturns, and if you look at the pattern implied by market price movements, that is more volatile, and they move quicker, and they moved quicker, sorry, than ratings do. And that chimes with some broader work we've done. Over the past probably 16 years or so, whenever you see a gap between the kind of credit risks implied by our ratings and implied by market prices, historically at least, it has been more frequently the case that the market moves towards the rating than the rating moves towards the market. And I'm very happy to share any of these kind of published pieces of research for anyone who's interested in them. We're aware it's a topic of great interest to many people. And more broadly, in fact, if you're interested in our coronavirus response, all of our coronavirus related research is free to view on our webpage at moodys.com. You might need to register, but you won't have to pay anything. The final point that I want to make is, again, I think I'm largely agreeing with many things that Richard has said. While ratings themselves are slightly pro-cyclical, particularly in credit downturns, as you would expect, given that we don't amplify the market, we think that these cliff effects are likely to be, in no small part, driven by the mechanistic or mechanical use of ratings, either in investment mandates or in collateral requirements or something like that. And our house view, our position for a long time has been that that should not be the case. We do not support the mechanical use of ratings in regulation or in investment mandates or indeed in anything else. They are meant to be a useful input to investors' decision making. They're our opinion on whether people will get their money back on full and in time. That's all we're talking to. That's the credit risk. But they are only supposed to be one ingredient. And we do not believe that ratings should be used mechanically in the kind of way that you've already heard. With that, and conscious of the fact I dropped off for a bit, I will stop. I've talked for probably slightly longer than I meant to. Elena, please let me hand it back to you.
Thank you very much. So this has been, all the 3 presentations have been highly interesting, and we have already a number of questions. Let me go back to the floor to the first 2 speakers. I don't know exactly how you want to share between the 2 of you. Maybe one of you starts and then the other addresses the remaining question. So first of all, feel free to comment on what both Richard and Colin just said. But let me add some other questions that already come from the floor. One is about, and it's not just for you, it's for the all speakers really, but let's start with you. One is about moratoria. In a way, we have seen the defaults, at least for the non-financial institution, less for banks, and we'll go back to that in a minute. But on the other side, at least in many countries, we have seen moratoria in place. And the moratoria tend to freeze, in a way, default risk. So why have we seen downgrades, even if through the moratoria, default risk have been frozen to some extent, or at least partly? The second one is more specific to the ESMA speakers. So the first one asks whether the CRA business continuity is considering also ICT and security business when in this business continuity plan. And the other one is instead on whether you can elaborate a little bit more on the risk assessment activities performed by the ESMA on the credit rating agency. So I think it was one of the points that you mentioned, and they asked for further clarification. And then finally, and then I give the microphone back to you, there was one comment on this issue that indeed non-financial corporations have been downgraded more than banks. So as Gwénaël in particular showed to us, banks have been mostly touched on the outlook dimension, but not so much on the rated dimension. Although I must say some of the Italian banks have been downgraded at least by Fitch following the downgrades of the sovereign. But it is true that in general, it has been more on the outlook perspective. So let me give the microphone back to you. Either of you. You decide. Maybe Stefan starts and then Gwénaël, and you take the question you would like. And then feel free to respond to Richard and Colin if you like.
That's okay. So I might start with, first of all, just on the moratorium question, just from the perspective of the CRA regulation. I think one of the things we touched upon earlier on was the sort of the non-interference in methodologies and credit ratings, and where that features within the regulation itself. So that's not something which you would say ESMA or a public authority in the EU has the power to do, in terms of it doesn't have the power to introduce a moratorium on CRAs credit rating actions, because the methodologies and the ratings need to be free from interference. Regarding the focus on ICT and cybersecurity, I think we also talked about how kind of in areas where we see the need to introduce some greater consistency amongst CRA's practices or within the market, we take the time maybe sometimes to introduce guidance. And actually this is an area where we have a consultation paper which is out at the moment, where it's focusing on internal controls for CRAs, and it does have a section which focuses on information security. So this is something which we look at and we think about. I might hand over to Gwen in case he would like to discuss, I think, the methodology question I think that Richard raised earlier on, which was quite relevant.
Thank you, Stephen. Thank you, Elena. Perhaps just to, let's say, go down the list of questions. On the moratoria, perhaps, Elena, you can clarify a little bit if you meant moratoria for example, people holding a mortgage, or whether you mean, let's say, more the central bank actions that were taken to, for example, the ECB and its collateral framework disregard certain downgrades. That wasn't fully clear to me.
I think the question just mentioned moratoria, but what I would imagine moratoria means is the moratoria that has been given to non-financial corporates in particular to suspend the payment on the loans and other payments they may be doing. So I think it's mostly related to that, and despite this, they have been downgraded. So this, I think, is more the question.
Sure.
Maybe also come up later on this issue.
Yeah, no, sure. I think also Colin will be well placed to answer a question with respect how methodologies incorporate those government measures. In principle, let's say from a CRA regulation perspective, CRAs need to incorporate information in a timely manner, making sure that their ratings stay up to date. So also those kinds of measures need to be considered by CRAs in their assessment. Coming back to the ICT risk and security, yes, definitely. Also in the current crisis, of course, where teleworking, of course, is something which has become widespread. Assessing IT operations and for example, also as IT security is definitely part of our interactions with CRAs. Going down the line to the risk assessment. So ESMA is a risk-based supervisor. So in that respect, we look at risks, let's say, from a probability and impact standpoint. So we have, let's say, identified the core areas of CRAs that we want to review, that we continuously monitor and update with all the information that we receive. This is then translated in risk scores, which we use to score the risks across entities. So that's a little bit more detail on the risk assessment. Let's say on banks, downgrades of banks, there as well, I think perhaps Colin can add a few words on that. And I think I'll pause there to see if the other speakers also want to intervene on this.
Richard, let me go back to you. So feel free to comment on these issues, for example, on moratoria, but I would say more generally, maybe this goes more to Colin again, but also to Richard. To which extent shall we incorporate regulatory measures, for example, of the type of moratoria in the methodologies for the ratings, and also state guarantees or other things that we have seen and will affect for sure the default risk, moratoria more in particular. And we know, for example, that for banks, once a borrower is under moratoria, there is a sort of freeze to the classification of loans, suggesting that indeed there is like a freezing of the default risk of the borrowers, and then the analysis is going to be performed when the moratoria is over. But to Richard, more in particular, I would like to, first of all, have your opinion on the last point that Colin said, when he said we don't advocate, and actually we are sort of against, if I may say so, the automatic application of ratings in regulation and investment portfolios analysis. So what would we suggest? Would we then suggest that indeed this link is broken and the regulation should not, regulation as well as investment portfolio? And then if we did that, many of the problems you mentioned, in particular the falling angels, somehow would disappear or be greatly mitigated. Is this the way to go? And if this is, can we get there, or how do we get there? And the other question that was posed to you instead in the Q&A is, what measure would you suggest to mitigate the adverse effect of ratings that you were mentioning? For example, subjectivity or pro-cyclicality, indeed, that Colin also said to some extent that they take into account, but maybe not fully. Please.
Right. Well, there are several issues that I wanted to comment on. I'll try to respond to your questions, Elena, but also a couple of the points made by the other participants. First, I just can't say strongly enough, that this is not an ordinary cycle. Colin referred to the last 3 credit cycles. This is not a credit. This is it is not an ordinary boom and bust cycle. If the rating agencies, as they seem to be, and I believe this is the case not only for Moody's, in our discussions, they're treating it, this is a cyclical movement. What goes down will go up. We try to raise rates through the cycle. I'm sorry, right? If your premise is that this is an ordinary cycle, I just disagree with that premise. The second point that Colin made was, I thought I heard a contradiction. On the one hand, you were agreeing, I think, Colin, that the CDS spreads movements in CDS spreads precede rating changes. And yet at the same time, or just a minute or so later, you said the markets move towards the ratings rather than the reverse. Well, that doesn't sound consistent to me, and maybe you can make it consistent. But the third point, and this is for Stephen, about methodology. You said ESMA, of course, doesn't interfere with the methodology. That's not your remit. On the other hand, your remit is to ensure that the ratings, that the methodologies are, to quote, rigorous, systematic, and consistent. And I'd like to know a little bit more about whether you believe that to be the case, how you control it, and just your assessment. My assessment would be, having looked at some of the documentation, my assessment would not be the same. It would not be that this is rigorous, etc. On cliff effects, yes, they are indeed driven by the mechanical use of ratings. That's because the mechanical stuff is still there. Now, Moody's may say that they are really against this. It's a terrible thing. But Moody's profits from the regulatory license, excuse me. profits very, very much from the regulatory license. And there has been very heavy lobbying, certainly in the United States, where it's been documented by Frank Partnoy and others. But there is very heavy lobbying on this issue. And also, let's be clear, for the supervisors, it's much easier for bank supervisors and other insurance supervisors, et cetera, to say, okay, the ratings are there. You got to follow. You've got to adjust to whatever happens to the ratings. And so there is a sort of defense there of the status, the regulatory license. And I think that's probably yes, that's where I'll stop. Thank you.
Is it okay if I jump in, Elena?
Yes, sure. So let me say more generally on this issue of moratorium, more specifically, that was addressed mostly probably to you. In general, also when we think about ratings of banks, how much do we want to take into account, for example, the recent mitigation in financial regulation? So how much do you incorporate moratoria for the borrower, for the non-financial corporates in particular, and also regulatory changes for banks, please? And then feel free to comment on all the other topics, in particular.
Okay, I will try. There's a lot of questions, and I'm going to miss some of them, but I'll try and cover as many as I can. So just on moratoria, the first point to note is that we rate to our own definition of default. We don't rate to anybody else's. And that definition includes things like missed payments or reduced principal, but it also has written in there, if the sovereign takes an action that results in a borrower not paying the coupon or the payment on time, that is still a default for us. So really important, we're very transparent about how we define default, and it's set out on our website. The reason I bring that up, it's kind of indirectly related, because actually most of the moratoria we've seen so far do tend to be heavily concentrated in terms of the mortgage and consumer finance sector, but also for some SMEs. And that across different countries. But the take-up is very different. So for example, in the Netherlands, the take-up on the mortgage moratoria has been much lower than in the United Kingdom. And the way we would normally think about that in terms of our assessment of banks would be what that would tell us about asset quality. Now, we are well aware that regulators have also taken measures to kind of provide banks with some flexibility in the treatment and recognition of those payment holidays. And that's, again, given the context of where we are, that's completely understandable. But we've also already heard banks start to say, actually, some of those that have taken payment holidays, that are enjoying the debt moratoria now, will struggle to meet their new payments on the new timetable and the new schedule when we come out of this on the other side. So our broad interpretation of the moratoria is we understand why they're happening. They're providing important support to companies and households that are using them at a very difficult time. But it does pose some broader questions about asset quality on the other side of this crisis. And this kind of leads into a point directly to respond to Richard. I never said this was a normal cycle. In the work we've just done on pro-cyclicality that we published, we're very empirical on how we define cycle. This isn't a theoretical concept around RBCs or exogenous shocks. We're simply looking at things like spikes in default rates to determine cycles. And that's the only context I was using it in here. We do not think this is normal. We do not think this is going to be like past cycles or past downturns. Maybe I can use that phrase. This is not the same as past recessions and past downturns. We know that. And that's why we've tried to be very, very transparent, setting out our approach in March, and also very measured in terms of what we're doing. On Richard's point just about the market and Moody's, so these are both empirical facts, which can sound a bit counterintuitive, but there's a number of explanations, and one pretty obvious one. So it is a fact that whenever you see a significant shock, bond prices and CDS prices will often move before you see a rating action. But it's also true that over time, if you look at the starting positions of bond and CDS prices versus ratings, and then you look at how that gap evolves, more frequently, the market moves towards Moody's than Moody's moves towards the market. And I'm very happy to share that research with anyone who's interested. There's a number of reasons why that could happen empirically. One obvious one is that the market overshoots a lot. And that's part of our desire as a rating agency. We want to be the signal, not the noise. So we might well be slower because we cannot respond as quickly. But one of the metrics that we judge ourselves on internally is rating reversals. We really don't like changing a rating and then having to unwind that change over a short period of time. Typically, again, historically, if you look at our ratings, only about 5% of all rating changes have been unwound in the subsequent year. And on average, over a long period of time, the best guess of what the rating will be in a year's time is the same thing as it is today. And that's a really important perspective for us. Very happy to share that work with anybody. Just to pick up on the NFCs versus banks point as well, I think others have broadly covered this, but the banks today, in general, look better positioned than they were going into the financial crisis. And this shock does not seem to be as directly impacting them. Leaving aside the moratoria discussion, which we can see some risks to asset quality there, but I wouldn't say those risks are particularly pronounced so far. This is just to Richard's point, this is just a very different shock, which is affecting different sectors in different ways. And if you are a bank, the impact that you are going to feel is going to be less pronounced than if you're a cruise ship. It just reflects the nature of the shock that we're seeing. I would also say, however, and this is again consistent with some of the measures that have been taken and our own credit views, fundamentally, banks have more capital and better liquidity today or certainly they did at the start of 2020, than they did in 2007. So a lot of work has gone in, both on the regulatory side, but also from the issuers, the banks themselves, to try and improve balance sheets, improve liquidity, and it's important to bear that in mind in the current context as well. I'm conscious of the time, so I'm going to stop there. Happy to keep going for a bit if others are able.
Okay, let me go back to ESMA. So first of all, let me pose the same question to you somehow. Why do we see so much still automatism in regulation and in investment portfolios? So in particular in regulation, why do we keep it? Can we do something about it? And do we want to do something about it? And second, some people are asking for the interaction between ESMA and the IOSCO. So whether the European framework and current measures that have been taken somehow is aligned or is different from the international standards. I don't know who of you want to take it. Please raise your hand, the one who want to take it. Maybe Gwénaël, let's see.
I think Stephen is best suited for the question on reliance, so I'll leave that.
Apologies.
Yeah, no, thanks guys. So let's say on the reliance part, this is something I think we were talking about. We did a lot of work on for a number of years. And one of the difficulties you realize in this work is the difficulty in finding something which can replace the credit rating in every situation for all types of market participants. So you can see in some cases where, say, for example, the money market fund regulation we talk about, you're talking about a specific type of entity and you have a specific type of purpose. So it's in some ways easier to come up with a solution which does not rely on ratings for this type of entity. But if you're talking about something which is much broader and sort of the universe of entities that you're dealing with in the regulation is much wider, it can be hard to come up with something which completely replaces them in all situations. So I think in some ways that's what possibly why some references remain, simply because it's difficult to propose workable alternatives which can apply in every situation to every entity. Actually, I might just like to come back to a point by Richard earlier on about the methodologies. This is something which ESMA does dedicate a lot of supervisory effort to in terms of assessing and trying to ensure high standards. And in particular, when we've issued guidance on the validation of methodologies in the past, and recently we've issued guidance on the standards for annual reviews or periodic reviews of credit ratings. So it's something which we do look at and we do spend a lot of time on. On the IOSCO, yes, there is a committee within IOSCO that deals with this and facilitates interaction between global regulators on credit rating activities, and they have issued in the past principles and good practices in that area. So there is a discussion. So I'll hand back to Gwen if maybe you want to answer anything.
Maybe let's go back to Richard. So some of the people say, first of all, going back to your issue of pro-cyclicality to some extent. So some people say there are covenants that are rating trigger in financial contracts. So this is part of the automatism.
Yeah.
Should we remove them again in order for not including pro-cyclicality? At the same time, some other people say, shall we use more convertible bonds going forward? Because if it is a convertible bond, then we can transform it, convert it into equity if default risk comes in, and that reduces default risk and makes somehow firms or banks or whoever the issuer are stronger. So would these two ways, removing these rating trigger covenants and in contracts, and on the other hand, instead using more convertible instruments, could they help in reducing this automatism or this potential impact of ratings?
Good questions. Let me first on the covenants. Yes, I think the supervisors, and in this case, I suppose it's ESMA. We've got them right here, right in front of us, and well, so to speak, virtually. I would like to see the supervisors of the if you like, the shadow banking sector. I know we're not supposed to use that term. Non-bank financial intermediaries. Like to see the supervisors engage in sustained discussion with the various financial institutions to ascertain to what extent they do rely mechanically in their contractual provisions, in usage, and so on and so forth. To what extent they do rely on, or yeah, I leave on usage, but in their products is what I meant to say, on the mechanical, if you like, application of ratings, and to see whether that can be reduced. I would push for that. I know it's more work, and ESMA is overstrained. I'm familiar with that problem, but I think it's important work, and we ought to be going in that direction. On convertibles, look, anything that might help to stabilize financial markets is a good thing. The question is what you can sell and what the markets will buy, right? And I can't answer that, right? Whether a substantial expansion, whether an attempt to sell a lot of convertibles would meet with wonderful market acceptance, I just don't know. So I'll pass on that. But let me just go back, and I just don't think I can stress this enough. I mean, Colin, you agreed that this is not a normal cycle, and yet in your remarks, you referred to historically negative outlooks lead to downgrades on about a third of the time. Well, historical examples may not be appropriate. You made another such reference about credit cycles in the US, past 2 or 3 downturns, etc. This is not an ordinary credit cycle. And that is what I was trying to stress. So if you're relying on that, on information from past credit cycles, I think that's a bit of a stretch. And finally, on Stephen, with respect, you said ESMA spends a lot of time looking at the methodologies, but you didn't answer my question. It's maybe it's indelicate, but still, my question about whether ESMA is satisfied that the ratings are rigorous, systematic, the methodologies are consistent, there is a minimum of judgmental factors and so forth in them. So I'll stop there for the moment.
Colin, back to you.
Thank you very much.
Also feel free, and again, please respond once again in particular to these issues of rating and their role during the cycle, given this, and I think we all agree on this, it's not a normal cycle, boom and bust. Yeah. But let me add one point which we haven't touched yet, which is on sovereign. So let me not ask you what do you think Italy is going to do, but let me ask you the following question. You said before that somehow your definition of default is your own one, and that if there are moratoria, that is somehow not something that you take into account, at least not fully, because in any case, this, and particularly also for banks, this anyway has an impact on the quality of the banks. But how shall I think then about all the policy measures that are concerned with the sovereign? So if I think now, for example, on the latest Commission proposal on the new recovery fund or whatever, or the SURE, or the ESMA, whatever tools you are thinking of that can help financing the sovereign, to which extent then would I think that you will consider those instruments in your ratings methodology? And that is my personal question. Let me say I take the burden, or I take responsibility for that, please.
Thank you. So to start with, I think Richard keeps trying to talk for me, which is bad. We're not relying on historical evidence or facts. I was merely setting out what we have seen in the past. And it actually, at the moment, I think there is a bit of a contradiction in terms of some of the previous remarks. We know that past models and past cycles may not be a particularly good guide now. We know that if you had a fantastic kind of quantitative model that was working brilliantly for the last 30 years, it may not be a good guide now. We're very conscious of that. But actually, that means that this is exactly the time where you need to apply judgment. You cannot rely on historical patterns and correlations, which are on a quantitative basis. And ultimately, of course, no model is ever going to be perfect. All models, all quantitative models, are necessarily simplifications of the way the real world works. We cannot ever capture the full range of complexities. So right now, we are exercising the judgment that's been referred to a few times. And we are trying to be as transparent and thoughtful about that as we can be by setting out our approach. Very clearly back in March, taking a kind of step-by-step approach, focusing our rating actions so far on where we see the weaknesses, which is in speculative grade. But I never used the word rely. I was merely setting out some past facts to set the historical context. That's all. We are exercising our judgment right now. We know this will be different. In terms of policy measures, we're also not ignoring the kind of debt moratoria issues. We're not ignoring the other policy measures that are being put into place for a range of sovereigns around the world. And again, I think that speaks very importantly to the flexibility to allow judgment to play a role in credit ratings, because policies evolve and change over time. And the policy responses within Europe or indeed elsewhere, we've already seen them evolve really quite significantly over the last 10 years since the Euro crisis. And that's something we absolutely have to take account in terms of our credit ratings and in terms of what we think both for sovereigns, but also for corporates and banks and other entities. We understand why payment moratoria are a sensible thing to do now, because you have millions of people who are no longer in employment or at best only furloughed. We have millions of, yes, probably millions of businesses, but certainly many, many thousands of businesses that have been very significantly impacted by this. But, it's difficult to try and incorporate those kinds of assessments of particularly new policies in any kind of formal quantitative framework where you can take the person out of the decision. Fundamentally, I just don't think you can do that. I think there always has to be a role for judgment. It's been true in forecasting, it's true in credit risk, it's true in all kinds of different approaches. In particular, I think you mentioned Italy very briefly. I think I would make the point that we have not taken a single rating action on any European sovereign as a consequence of this crisis yet. And we've been very clear in our research, again, which is free to read for everyone, that for those sovereigns which have stronger credit ratings, which are advanced economies with probably more resilience over this crisis than some other entities, we know that in these kinds of situations, the government is the only infinitely lived actor in the economy. Firms can go bust, banks can go bust, households can suffer financial distress and lose property. And we understand that in these kinds of situations, it is often the government balance sheet that is used to provide support, whether that's on a national basis or a supranational basis through entities like the EU or other bodies. What we have said is, this will use up fiscal space. Debt to GDP for a number of sovereigns will be higher on the other side of this crisis, which we expect, we expect to take it some time to even get back to where we were at the end of 2019. We're not thinking that's going to be quick in terms of the economy anytime soon. And that simply means that if there's another crisis down the line, you start from a worse position than you did coming into this one. So what we have said is we're going to look very closely at the plans governments put in place when we're starting to come out of this. We're looking on for what they say they are going to do on deficits and debt on the other side. But so far, all of our sovereign rating actions have been outside Europe. A number of them have been linked, of course, to the World Bank and IMF proposal around the suspension of official sector payments. I would just like to spend a little moment on this because I think it's also in one of the questions in the Q&A. So our ratings speak to private sector obligations, typically. We don't rate official sector obligations, for example, from Greece to the rest of the Eurozone or anything like that. We rate the debt that private creditors hold. And that's important because whenever you see a kind of moratorium on an official sector payment, or when Greece's debt has been restructured in the past with cutting of interest rate or a lengthening of maturities, other things being equal, those actions imply a lower financial value for creditors than would otherwise be the case. And under our default definitions, that kind of reduction in financial value would ordinarily constitute a default. But we haven't called those defaults because they're not the things we rate. Right? We rate the private sector obligations. And this is the point around the current proposal from the IMF, the G20, and the World Bank, which is completely understandable to try and provide a little more breathing space for some of those weaker indebted nations that face some payment hurdles this year. Now, the official sector side of that is not what concerns us. It is the possibility that private sector creditors will also be required to take haircuts or be asked to take haircuts and contribute to some form of restructuring, voluntary or otherwise. And that, for example, is why our Pakistan rating at the moment is placed on review for downgrade, because we know that Pakistan is interested in exploring this option, and it may well result in financial value losses for creditors. So I just wanted to touch on that because it came up in one of the Q&As. But so far, we haven't taken any rating actions on any European sovereign. The Italian rating remains Baa3 with a stable outlook. But we will be looking closely at what governments do on the other side of this.
Thank you very much. And thank you very much. I think we are now sort of closing because it's 2:14. So let me give just the microphone back to maybe Stefan or Gwénaël, one of the two, please, given that we are a bit late, if you want to make some final remarks. And then have yet still one specific question for Richard.
Sure. Thanks, Elena. Just coming back to Richard's point, which you raised twice on the methodology side, what Stephen referred to as methodology is being rigorous, systematic, and continuous. Those are definitions that are included in the regulation, also in the technical standard that's been drafted as a result of that. So rigorousness means that all key driving factors are included in the methodology. A systematic application means that it needs to be applied systematically across all ratings. And on continuously, it means that basically it can deal with changing circumstances. That's in a nutshell, let's say, how the framework is set. Perhaps to distinguish slightly between that and having a qualitative overlay, according to the CRA regulation, a rating needs to include some form of qualitative assessment. If it's merely the output of a model, it's defined as a credit score, which means that it doesn't fall within the definition of credit rating according to the regulation, which then of course also means that it cannot be used for regulatory purposes, because that's also something which is one of the driving factors of the CRA regulation. On your slightly provocative question about whether ESMA thinks that all methodologies are rigorous, systematic, and continuous, that's of course impossible for us to make a blanket statement on. just to specify a little bit, ESMA has actually very recently taken supervisory measures in this area, which you can find on our website actually. So that's just, I hope that answers, at least as closing remarks. I just wanted to answer that question, and also thank Richard, Colin, and Elena for the interesting discussion.
Thank you to both you and Stefan for participating. Let me just give the final word to Richard, and let me read out one of the questions in the Q&A. So please ask the question to Richard about how he expects rating agencies to ignore economic changes to be less pro-cyclical. How can he justify this when the economic reality changes completely, as he himself pointed out? Please.
I've never said anything of the kind. I expect the rating agencies to react to the economic data. The question about pro-cyclicality is another matter. It's not a question directly for the agencies. It's a question for the mechanical application. It's a question regarding the mechanical application of ratings in the portfolio decisions of investors. And that is what is pro-cyclical. The ratings should, of course, follow the data. And I didn't say otherwise. I would just raise a question. I wonder what's happened to your CLO correlations, Colin. And I wonder whether ESMA is wondering that, given the wave of negative watch and downgrades of CLOs that we saw, were the correlations that you were employing, as in the past, rather optimistic? But maybe that's for another day. But I think it's something that ESMA should certainly be looking at too. It's been a very good discussion, lots of interesting questions, and even in a virtual room, we got the elephant. You, Elena, got the elephant into the virtual room, the sovereigns. I was trying to keep the elephant out, but there it is. It's been very good. Thank you all for the interesting discussion.
Thank you, Richard. I see Colin has raised his finger, not even his hand. So one sentence, please.
Okay, with one sentence, I just want to say thank you very much as well to all of the participants. I've really enjoyed this, and also to all of the attendees. We really, really want to get your views and opinions as well. So if you have further questions we haven't been able to answer, if you have ideas for what we should be doing better, please feel free to reach out to me. You'll find my details on the website.
Thank you very much. So let me remind actually everybody that the slides will be distributed and the video will be, it's recorded and it will be posted so that everybody can still see it if he or she wants to do it. And let me also thank all of you for this most interesting discussion and for being with us today, together also with this participant and their questions. Thank you very much, and to the next occasion. Bye-bye, everybody.
Bye-bye.